Okay, everybody's back. All right. So on this one, Gladys, how about if you start for us? Let me go to the page. Um, so Gladys, tell me what was your initial outflow?
So initial outflow was 4 million, 4,050,000.
Yes. How'd you get that?
I added the capital expenditure with the net working capital.
Good. This is a more standard case where we spend money to acquire the piece of equipment for 3.9 million, and we have to build up working capital. So we spend on working capital too. So we add those two together to come up with our total initial outlay of 4,050,000. Now, for an accounting standpoint, the only thing we're going to depreciate is that 3.9 million piece of equipment. Okay, so the initial outlay is all of the costs that we have to incur initially. The only depreciable asset here is that piece of equipment for 3.9 million. All right, good. Okay, so we have an initial outlay of 4,050,000. So now we need to figure out our operating cash flows. So Mike, go ahead and tell us how you did that.
So I just did like the sales minus cost of goods sold, which was 25% of the sales.
Good.
And subtracted the depreciation, which I calculated to be 975,000.
Good. So it was 4-year depreciation on the $3.9 million asset. Okay.
Yeah. And that got the earnings before interest and tax. And the tax was 35% of that. And then I just got the operating cash flow from the earnings before interest and tax plus depreciation minus tax.
Excellent.
Then that was the cash flow for the first 3 years. And then for the fourth year, it was that plus 150,000 net working capital.
Outstanding. Okay, so what do we have? We have an initial outlay of $4,050,000, the $3.9 million piece of machinery, and the $150,000 we have to spend initially in working capital. Then we go to our pro forma. We have sales of $2,350,000 per year. We have costs of 25% of that. 25% of 2.35 million is 587,500. We have depreciation. It's straight line depreciation for 4 years. So 1/4 of the $3.9 million initial outlay gives me depreciation expense of 975,000 per year. Subtract depreciation costs from sales to get to my EBIT or EBIT. We're just not counting interest right now. Not 787,500. Mike, turn off your mic. Oh, somebody's got a mic on. Pop it off, Mike. It's not you. It's somebody else. Our tax rate is 35%. So 35% taxes is 275,625 to give me a net income of 511,000. You don't have to calculate net income. It just completes your pro forma. So my operating cash flow is my EBIT plus depreciation minus taxes to get to this 1.486 million. Okay, what questions can I answer for you about this part? Who's got a question? Pretty normal. It's very similar to the problem we just did, except the working capital was this is the standard case where you spend money up front and you recover at the end. And so what Gladys told us is we've got 4,050,000 expended initially. What Mike's told us is we have 1,486,875 for years 1, 2, and 3. And then year 4, we have that same 1,486,000, but that working capital that we spent initially, we're going to recover. So in the 5th year, we're going to add that 150,000 in here in order to get our year 5 cash flow. So here's our cash flows. We have 4,050,000 initially, 3.9 million plus the 150,000 in working capital we have to expend. We have our operating cash flows for the next 3 years. And then in the 4th year, we have our operating cash flow plus we recover that 150,000. They tell us we have a discount rate of 13%. So when we do that calculation, we come up with an NPV of 464,664. Is this a project you should look to pursue? Anybody want to go forward with this project? Gladys, you want to do this project?
I'm not sure. So I don't know if I did the IRR correctly, but
Oh, what'd you get
what
for
I have,
IRR?
18.34.
You did it exactly correctly. So
So
then
I guess I would move forward because the
Aye.
required rate of return is 13.
Exactly. It requires a 13% return. If you calculated the IRR, it came up to be 18%. It's a good project. And if you calculated the NPV, a positive NPV, anything over zero says you're adding value for your company. So this is a good project. What questions do you have about this one before I have you do another one? Y'all just are not trying to slow me down. Okay. This one I want to talk about a little bit before we start it. They're looking for a piece of equipment that costs $415,000, has a 5-year life, fully depreciated. Okay, so we're going to fully depreciate the asset over the 5-year life. So straight line depreciation, it's 1/5 of the $415,000. Then separate from that, we believe we're going to be able to sell it for $50,000 at the end of the life. Remember, if it's fully depreciated, we sell it for $50,000, we're going to have to pay taxes on that. So you want to look at the after-tax salvage value cash inflow in the 5th year. This is going to replace 4 employees whose salary is $120,000. So this is like your sales less costs. You're going to save $120,000. It will lower your working capital by $80,000, but you're going to have to replace that at the end. Tax rate's 34%. And should you buy this computer if the discount rate is 9%? Pretty straightforward. A couple things are switched in direction. Take a snapshot of this one so you're ready to work on the problem in your rooms. Any questions before I pop you into rooms? And calculate an NPV on this one as well. All right, I'm going to open your rooms to hop over there whenever you're ready, and I'll come in again and check on you, but I'll stay in here in case you have any questions.